If you're watching the recorded version of this webinar, it was held live on Wednesday, April the 18th at 12:30 in the afternoon. So this webinar runs for half an hour, and we look at a couple of things. We'll look at the major markets, the major currency pairs, indices, commodities, and we also do a bit on trading strategy. So what we're doing this time round is money management, which I think is something that plenty of people pay very little attention to in the beginning, to their cost, and it's arguably one of the most important pillars of trading. So we'll take a look at that. Just while that risks warning's up for a bit, I'll keep talking. So I think the big news today, the market will start off with, is the pound. So we'll have a look at pound US dollar. Yesterday it hit its best levels, I think, since the EU referendum vote in June 2016. And if you've been on this webinar for a while, we've been saying how bullish it's been the last few months. All the way through last year, the trend was still up. But today it's been hit quite hard, and it's hit because inflation data, which was released this morning, came in at its lowest for a year, I think. So it missed expectations, so below expectations. And of course, the classic way of combating high inflation or rising inflation is to raise rates. So I think for some people, the fact that it's a lower than expected inflation today has maybe thrown a question about whether we'll get a rate rise from the Bank of England in May. So that's why we've seen the pound knocked today. I mean, it's a big move, but to be honest, it's come so far in the last few weeks in the great scheme of things. I don't think it's that major. But let's take a look anyway. Let's get into it. Hold on a sec. Oh, haven't set my screens up properly. Hold on. Right, here we go. Okay. So what we're doing, we're using Aondo's Trade Hub trading platform for today. So all the charts will be on that. So let's start off by looking at this pound US dollar move. Let's just bring that up. Okay, so what's this? This is, let's make it into, it's a 1 minute chart. Let's look on an hourly chart. There you go, there's the move. It's a big old move. If you look at the last, couple of weeks or so, we haven't really seen any big sell-offs. We've just seen little corrections against the trend as the market's pushed higher. So the move, coming into today, the market was trading above 143. It's dipped below 141.80, so we've seen 120, 130 point move this morning, and it is starting to recover. But let's just to put this into perspective, let's see where we are. Let's start off with a weekly view, the really big picture view. So that's where we are. So it's the highest closing price, I presume, then end of last week since the old Brexit vote. So we're back up, into this zone, and it's still bullish. I think if we plonk our trend lines on there, there is no doubting the trend for the pound. Yes, there we go. Going back to at least March of last year. So we're more than 12 months into this. Any weakness still looks like a buying opportunity. I think the obvious next target, if it can break the highs from earlier in the year, so if we see a move through 144, let's say, I think the obvious next target is to have a look at these pre-referendum highs at 147. Let's just change this over to a daily and sort of start stepping things in. Here we go. So there's our trends. It did just about poke higher yesterday by the looks of it. So I had a little look above those old highs, and it's come off quite heavily today. But it doesn't change the trend, and it does demonstrate, just in case anyone needed convincing, how important it is to trade with the trend, because that trend has been definitely up. And there's lots of negative news that came out about the pound last year, but the market, carried on rising. So clearly the market view was that maybe some of the Brexit pessimism was being overdone. I think it's interesting to see what happens next. It's come a long way in the last couple of months. Let's just pick up on some of those levels. So I think that really the big level is 137-ish, near enough. So 137 is a big level. I think it's only if we start to lose that does it start to look like that trend is ending. So for now, it's the classic buy the dips market. So that's what it looks like. Maybe a bit, no, didn't quite have bearish divergence. It went a little bit overbought yesterday on the RSI, on the squiggle down here. But let's take a look. Let's take it one step in closer to see what the levels are. to watch out for. I don't think we've seen the end of the rise. You know, it's very rare that we see the market turn around and just sell off. You know, look what it did back here. It did sell off for a few days, but had another look before really selling off. So, you know, for me, I'd probably favour another go at that level. So I think there are a couple of things to do here. I think the patient trade would be to wait till tomorrow, because we've seen a big sell-off, relatively speaking, today. So let's wait till tomorrow, wait for the dust to settle, and then take it from there. But the less patient trades, I mean, there's our hourly chart, is up, going back to beginning of March, so we're 6 weeks into that. The more aggressive trade, I should say, it would be to buy it now, wherever it is, 42.13, with a stop loss under this morning's low, taking the view that the market has overreacted to the inflation number coming out. Okay, so that would be a buy at 142.13 with a stop below 141.70. I think maybe a better place for a stop loss is picking up on some of these old levels a little bit further out, 141.45, that sort of area. But for me, I would be expecting the market to have another look at those old highs. You know, the only question is, do we plop a bit lower from here, maybe back to this trend before we have a look? But I think there are a couple of interesting levels to keep an eye on. It's gone very oversold on the hourlies, as you'd expect. This is the most oversold since back here, back at the end of Feb. So the RSI is pretty oversold. But actually, let me make that a 10-day RSI or a 10 event RSI. Yeah, it's still pretty oversold. So I think it's interesting, you know, given the shock it's had today, to see what happens for the rest of today. But I think there are a couple of ideas in there. If you thought, well, okay, the market is going to bounce back from here, but it hasn't changed that bigger picture trend for the pound. And it's only if we lose those lows from Feb at 137 does it start to look as if it's in a little bit of trouble. So let's see what happens. What other market? Let's look at euro sterling while we're looking at the pound. Let's look at euro sterling, because I don't pay attention to this one during the week, but yes, I thought it had. I think I remember reading somewhere it had broken out of that channel. So this is interesting, because we sort of look at this now and again, and I've been saying sort of really how boring it's been since September of last year. So this is euro against the pound. Been trapped in sort of 87 to 90, but over the last week it has blipped below that channel. So classically that would suggest that we're going to see the start of a sell-off, but so far it hasn't happened. You know, we've seen the euro clearly bounce back today on the pound weakness. I would say that maybe the contrarian aggressive trade here is to treat this as a false break and be a buyer. I mean, ideally, I've been a buyer yesterday, not today, but I do like this idea of sort of false break trades where you have a big move through a level and then it doesn't really move much further. You know, it can be, if you're going against it, you know, you want to be a buyer 86.50 or something, and with a stop loss under the most recent low. So I think it's interesting what's happened here, but at the moment, I might be inclined to think that was something of a false break. Let's see. I think if it sort of confirms the break by slipping below yesterday's low, about 86.20, I think we could see a much bigger slide in the euro against the pound. You know, maybe back ultimately to these old levels from May 2012. May 2012? No, it's not May 2012. May the 12th. What am I talking about? Around about 84. Let's see what happens. But I think that's an interesting one. But clearly, we've seen a bit of euro strength today off the back of that pound weakness. Just on the subject of false breaks, so trades I identified and never did. Dollar yen was one we looked at a while back. Oh, hang on, this is frozen. Oh, there it is. A similar sort of thing where the dollar has been really pummeled over recent months against the yen. So clearly, dollar yen, when we see the chart sliding, what we're looking at is dollar weakness. But we had the move down here, sort of 105.60, dibbled around, breaks through on one day. But again, we don't really get the follow through. So the aggressive trade is to be a buyer with stops underneath. And it has bounced back. But I think what's interesting is this sort of 108 level on dollar yen. I think if we got a breakthrough there, that could really, I think, pick up some sort of recovery. So I think it's an interesting one, dollar yen. If we do get a sell-off back down to here, does the level hold again? But that was, again, an example, I think, of a false break where we didn't get any real follow through. So the strong move down and the market just went sideways for a couple of days. So again, an aggressive trade. And I've used this a lot the last few weeks with success. They don't all work out, but when they go wrong for a small loss. And when they go right, you hopefully catch the bigger move up. But there's a good example there. Breaks, doesn't follow through. So I suppose you could buy here with a stop loss under the lows and then trail the stop if the market starts to pick up. But it's interesting at the moment. But for that pound US dollar, I am expecting a recovery from here. This move today is quite possibly a little bit overdone. But let's see where we are at the end of the day, I think. But lots of support levels underneath the current price, including today's low, that maybe we'll set up some sort of bounce back up and have a look at 144. Let's talk a little bit about the trading strategy stuff. Oh, where's that gone? Hold on a second. Let me just juggle my screen around a bit here. Why does that keep coming back? So we'll talk about money management. So let me see if this is going to work. I'll flip my screen over. Oh God, just work, will you? There we go. Flip my screen over. Everyone ignores this. Because, not everybody, but lots of people in the beginning ignore it because they think that trading markets is all about Bollinger Bands and MACDs and what color Lamborghini you're going to buy when Bitcoin goes to 100,000. But the money management side is really important. So if I do the usual examples just to make the maths easier for me, let's say you have an account of £10,000, for example. How much would you risk losing on any one trade? And I in my experience, having worked in the industry since about 2005, 90% of people don't give any thought to this. But the most sensible and I think widely used approach to risk management is that you risk less than 3% of your trading account on any one trading idea. So what does that mean? Let's take pound US dollar as an example. Let's take the example where I'm going to buy it at 142.13 and I'm going to put my stop loss not below today's low, but below those other lows off the chart. So I'm going to put my stop loss at 141. Let me make the maths easy for me, 33. Okay, so I'm going to buy it at 42.13 and a stop at 141.33. So that stop loss in that example is 80 points away. Okay, so I've got an 80-point stop loss. And I think the mistake a lot of people make is they'll just trade the same size regardless. So they'll trade pound against the dollar and they always do £5 a point, pound against the dollar. But if you've got a 30-point stop loss or an 80-point stop loss, those are clearly two completely different risk profiles. Okay, so we need to think about how much we risk and risk the same, I would suggest, the same uniform amount on any one trade. So let's go back to here. So if most sensible approaches to risk management suggest we should only be risking 3% of our account, let's say less than 3% of our account, let's say we decide to risk 2% of our account on any one trade. So in this example, 2% of £10,000 equals 200 quid. So if we're risking 200 quid on each trade, all we need to figure out next is, well, how big should we trade? So I've just opened up the calculator on my phone. So clearly 200 is the amount we're allowed to risk losing, divided by 80 points. That's our stop loss. So 200 divided by 80 is, we should do a trade where our risk is only, I could have done that in my head really, couldn't I? Is only £2.50 a point. Okay, so that way, if we bought it at 42.13 and got stopped at 41.33, okay, it's a losing trade. That's all part of life. We've lost 80 points, but at £2.50 a point, we've only lost 200 quid. So we've only lost 2% of our account as we plan to. The reality is, of course, most people don't have 10 grand accounts. So the average account, let's say the average account when people start trading is 1,000 quid. Then doing a risk of 2% means you're only allowed to lose 20 quid. So if you're trading a volatile market like a currency, you're only allowed to trade not £2.50 a point, but you're only allowed to trade 25p per point. And people think, well, it's going to be a long time for me to get rich trading 25p. So they ignore all that completely, of course, and just risk losing 200 quid of their 1,000 quid account, for example. So they're risking 20% on any one trade, which is a mug's game, is the quick answer to that. You know, most people lose money because I think poor risk management plays a major part here. So give it some thought. You know, if you're trading and you intend to be trading for a while, then you should think about the level of risk that you're taking and what percentage of your overall trading pot that represents. So for me, I have for years and years stuck rigidly to less than 3% or less risk. So if any one trade goes wrong, which of course plenty of them will, you're not taken out of the game. You know, you're still in the game. But people don't like to hear that because it's boring. But that's the way it is. It's having a sensible, mature approach to trading. Right, let's flip it back to the screens. Flip it back to the screens. Where is it? There it is. Okay, so we've done a bit on FX. Oh, let's do euro. We haven't looked at euro dollar. Let's have a quick look at that one. So there's our pound against the dollar. Euro dollar's been boring. We're going to get a breakout in euro dollar one day. It's just not happening yet. You know, we've been stuck now in this range for about 2 months. You know, the trend is, I think, still just about up for euro dollar. So it looks something like that. The big level are the lows on the downside, which is here. So the 1st of March lows at 121.50. Down here, the highs up here, and it's just trapped. You know, it's just highs up here at 25.50, and it's just trapped in a range. So you'd have to say, or I'd have to say, considering the trend is up, the expectation would be for a breakout to the upside, but it's not happening yet. You know, but on the downside, 121.50, 122 is bringing the buyers back in. So it's just pretty dull at the moment. So the same as it was last week. Not much change to that really. So let's see. But I think what is interesting, I don't know, I think we haven't looked at this before. If you go back years on euro dollar, so this would negate the upside breakout argument. Look at that trend. We're still in that downtrend. I think we may have looked at this before. We're still in the downtrend from 2008. So when we were all 10 years younger. And 126 pretty much is where that downtrend's coming in. So if you are a long-term trader of euro dollar looking to take a position over the next 10 years, you know, arguably it's an interesting level up here. Well, not the next 10 years, the next couple of years. It's an interesting level up here where that long-term trend is coming back into play again. So it's even though it's been dull the last couple of months, it's pretty interesting, I think, what the rest of the year could hold for euro dollar. So we'll see. But I think that long-term view is an interesting one on that. Right, let's take a look at stock markets. Stock markets have been a bit perkier this week. Let's have a look on the S&P first of all. So the S&P is looking strong at the moment in the overnight market. We've still got an hour and a half-ish until US markets open officially. And it's doing sort of what we expected. You know, after all that sort of shock and awe that came to the markets at the end of Jan, if I draw, where's my trend line going to go? Something like that. We're still within the overall trend, but I think plenty of people will have been spooked by this relatively big sell-off that we saw. So for me, okay, it's strong at the moment, but I'm expecting it to run out of steam and turn down again at some point. But there is no denying the strength at the moment. And we had the classic, you know, the classic big level down here at these lows, 25.30 lows. The big lows after the sell-off, test it again a couple of days later, and then beginning of April comes back down to 25.60. So that is confirming at least that's a good base so far. I think if we see those lows broken at some point, you'd expect a much deeper sell-off. But maybe now the theme is just going to be chop, 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 you know, rangy, choppy markets. Let's take a look on the hourlies and have a look. Look at that S&P trend go. So and again, is that a false break? Am I stretching this false break thing a bit too far? Yeah, maybe I am with that one down there. But the market over the last couple of weeks has made this base around 25.50, and going back, you know, the last few days, pretty low volatility. You know, sort of small hourly candles, but that trend still merrily chugging higher. So, looking something like that. So at the moment, we've cleared the old 2680 resistance on the S&P. We've got quite a bit maybe coming in 2735. And then after that, these sort of old levels up here. So the trend is definitely up for now. I wouldn't want to be trying to call a top, particularly as in the last hour, it's made a new high for this up move. But I'd be buying it if anything. But I think I'd be expecting it to run out of steam at some point and maybe have another look at these old lows, just because I'm expecting something of a choppy market. But it's been a good bounce back over the last 12 days or so for markets. Let's take a look at the FTSE. FTSE, here we go. So the FTSE again, if we flip it to a daily to get that bigger picture. So the FTSE again, it's always an odd one, the FTSE. I think I say this every week, because the effect the pound has. A strong pound puts a bit of weight on any FTSE progress. A weak pound will help lift the FTSE. So I'm sure that's helping it a little bit today. So the FTSE again is strong, following those US markets higher. But the big level to watch is going to be up here. What's going to happen if the market gets back up to these sort of 7,300, 7,350-ish area? Because it was a bit of a problem on the way up, and the market did push out and break below those January lows, Jan-Feb lows. So I think it's interesting, the FTSE. Where are we now? 72.90. So we're only 50 points away from it. So you could argue, if you really thought the stock markets were going to fall off a cliff again, it's a good risk-reward level for the FTSE, because you're going short at 72.90, and you'd have your stop loss, or I'd have my stop loss somewhere above here, somewhere. So maybe less than 100 points risk for maybe lots of downside if the market does turn. But I think it's going to be interesting to see what happens up at these levels. But while the US market is still strong, we'd expect the FTSE to continue getting dragged up there. And then let's have a quick look at the DAX before we take a look at gold and oil. The DAX is the same, isn't it? Where with the FTSE, it's banging back at these levels, these old levels up here. So we're about 12.6 on the DAX, and if we pick up on the bigger level, 12.750 up here. So I think it's interesting, actually. If you looked at the US stock market in isolation, it looks like it's still got quite a bit further to go on the upside. You look at the DAX and the FTSE, maybe we're getting near towards what could be something of a turning point where any recent buyers decide to take some money off the table. So stock markets could be interesting over the next week or so. Let's see. I'm not doing the webinar next week because I'm away next week. So we'll have to find out what happens in May with the webinars. Yeah, let's see what happens. But I think clearly for me, it's the US market is the important one. And on this chart, on the dailies for the S&P, we are quite a long way away from any sort of previous resistance. Let's see what happens. Let's take a look at gold and oil. We'll look at gold quickly, then look at oil, because I think oil is a really interesting market at the moment. But let's just have a quick look at the price of gold, which, like the euro, is just stuck. Let's start off with a big picture view. I do think the next few years we could see further gains for the price of gold. So this is a weekly candlestick, and I've been bullish on gold I think for a bit, because it broke out in when did it break out? 2016. It broke out of the most recent bit of the downtrend, pushed higher, sold off, didn't take out the old lows, and it's trying to push higher again, but cannot get through these old levels, cannot get through the highs from the summer of 2016, around about 1375. But it's not getting clobbered down either, so it's interesting, but it's interesting but boring, I suppose. It's boring if you're watching it day to day, because we just see it in this tight sideways range. But let's see what happens up here. 1375 is the level it needs to break on the upside. 1300 on the downside is providing support, and it just knocks its way around in that range. So maybe if it breaks out, things will get a bit more interesting, but it's still pretty much stuck in that sideways range for now. And let's finish things up on oil. I don't think we have that much data for oil, but it is interesting because we're trading, pretty much near multi-year highs for the price of oil. We had the trend since last summer is up. Oil was $42 a barrel back in the summer of last year. It's now, where is it now? 67 at the moment, $67.50 a barrel at the moment. So it's up 50%. Again, I really do like these false break things. We had a little bit of a false break. When was that? yesterday, where we'd had on the hourlies, in the hourlies, the market come down on April the 12th, rallied, comes back down April the 16th, holds, breaks yesterday for 1 hour, but then turns around and pushes back to the old highs. So there was clearly not much selling pressure following the break. So again, an interesting opportunity there. And we're back up. We're back up near these multi-year highs. I think at the moment, the obvious next target for oil is about 70. And I think there are big historical levels. If you can look at a long-term chart of oil, we can't look at it on here because we're looking at an actual contract, the May contract. So we don't have data going back. But oil fell really heavily from above $100 down to about 60 with not much in the way of sort of major rallies. So there is a lot of fresh air above the current price, but I think $75 is something of a big level. But I think immediately, assuming we see 67.5 broken, then $70 looks like the next immediate target. But it's still a market that brings the buyers back out. Yeah, of course we get corrections along the way, but for me, at the moment at least, I would not be looking to pick a top in the price in oil. I'd be looking to buy the dips. If we get sell-offs, look for a place where sentiment changes and a sensible place for a stop, and away we go. We did have actually on this dip. This is interesting. Long-term sufferers of the webinar will know I am usually not a fan of the old squiggles down here, the RSIs. But here we had the market pushed for low, push lower still, but the RSI, look at the RSI. The RSI was doing bullish divergence. So the market, blinking flip, that's not going to show it. Okay, the market was making a low, then a low. The RSI was making higher lows. So this can be a suggestion, and it did end up being that the weakness, even though it looks weak, the weakness is running out of steam. So this bullish divergence thing can be a good sign that maybe things are changing, and it did work there. Let's see. Clearly, it's overbought now on the squiggle down here, so maybe we'll see a bit of weakness. And we've got the oil inventories this afternoon. Wednesday afternoon is oil inventories, so that could be some volatility. But interesting. Oil is still an incredibly strong market. Oh, we've had one request. We don't normally do requests on this, mainly because we don't get them. But we've had one request for Intel. Let's have a look at Intel. I don't know why they're interesting, or if they are interesting. They got results out today or something. Let's have a look. Intel Corp. All right, let's have a look. So look on a daily chart. Whoa, it looks like a little breakout, doesn't it? It's almost gearing up for a breakout, Intel. And I think again for stock traders or stock investors, if you're not sitting there worrying about every little cent move, which I don't think you should, breakouts can be interesting. We had one back here, September 2016, all the way through. Well, a year that the price of Intel was capped by $38, and it broke out, and away it went. We haven't got the same in terms of time for Intel, but the old highs, the spiky high from March, is about 53. Let's call it $54. $54 is the level, and if it breaks through, you would normally think it would suggest that maybe we're going to see the market start to move higher. But Intel, that's an interesting one at the moment, isn't it? So 54, I think, is the big level to watch on Intel. We've got nothing else coming up on the chart. So yeah, 54 would be a breakout on Intel and suggest it's going to the moon or somewhere maybe before that. I suppose if we looked at the channel, it's about it's $8 high. So 54 would give us a target of about 62. I think if we saw that level break. So Intel could be an interesting one to keep an eye on. Right, we will wrap things up there. So I'm away next week. There's no webinar next week. Pound US dollar looks like a really interesting one to watch, given the sharp sell-off we've seen today because of the inflation data that came out lower than expected, questioning, is the Bank of England going to raise rates? So that'll be an interesting one to watch. Stock markets are interesting anyway because of the craziness that we had in Jan, Feb, and the price of oil is still strong. So plenty to keep an eye on. We'll wrap things up there. Thanks for coming along, and enjoy the rest of your afternoon.